In this video, I'll be talking about market structure. And if you have not watched my previous video on the foundation of Forex market analysis, you need to go and watch it because this is the continuation of that video. And also to get notification on my next video as soon as they are uploaded, you can subscribe to this channel. You can also drop your comments in the comment below, in case if you have any question, and I will respond to you immediately. So now, what is market structure? Why do you need it? So market structure is a price action techniques that uses the price of the market highs and the lows, otherwise known as support and resistance, to determine one, the trend direction of the market, two, the potential trend continuation, and three, the potential trend reversal. So that is why having a perfect knowledge of market structure in Forex trading is very, very important, because without you knowing the direction of the market, where the possible reversal might take place, or whether the trend is continuing, if you don't have those understanding, you being profitable in the Forex market might be difficult. So you need to have the perfect understanding of what a market structure is for you to be successful in Forex trading. So therefore, having a perfect understanding of the structure of the market will give you an edge in the market. So as a Forex trader, before you think of buying or selling, the first thing you must do is to study the structure of the market for direction. So what do I mean? If you look at my screen now, you will see this, the highs. Remember, I said you talk about the highs and the lows. The lows, the high, the low, the high. Or you can say the higher low, the higher high, the higher low, the higher high, the higher low, the higher high, and so on. That is a structure in the market. So now, how do you use this to determine the direction of the market? How do you use it to know the trend continuation or the trend reversal? So you look at this drawing that I have here, the high, the low, the higher high, the higher low, the higher high. This is the structure of a particular market, the price movement of this particular instrument. So if you look at these points now, here you have a high, or here, let me start from here. Here you have a low, here you have a high, here you have another low, here you have another high, here you have another low, here you have another high. So we call this one the low, the high, the higher low, higher high. Or you say the higher low, the higher high, the higher low, the higher high, the higher low, the higher high, and so on. So how do you use this to determine the trend of the market? When you have an higher high, when the market begins to create higher highs, that means you have an uptrend. The direction of the market is up, or bullish, or buy. So when you are having higher highs in the market, that means you are to do what? You are to buy in that market. You have to look for buy opportunity when market is creating higher highs. As soon as you have a break of structure, so we call this one here break of structure. So when market creates a low, and it creates an higher high. It creates another higher low. The moment it creates an higher high, this particular point you are looking at, where my cursor is now, is a structure that was broken. We call that place a resistance. So this resistance that was broken to create an higher high. Okay, the resistance was broken here to create an higher high. So this is a structure here that was broken, and this gives you the confirmation that this market is moving up as soon as this structure is broken. So when the market is creating higher high and higher low, that means you are having an uptrend. You can see the movement up here. So for the bearish now, we have the low, the lower high, the lower low, the lower high, the lower low, and so on and so forth. So the moment the market begins to create lower low, as we have it here now, the moment market begins to create lower low, as we have it here, lower low, otherwise known as support. So the moment it's creating lower low, then you are having a downtrend. When the market is creating higher high, what are you having? You're having uptrend. So that is it. That is how you use market structure to get the direction of the market. Now, how do you use market structure to know whether there will be trend continuation or a reversal? How do you use market structure to determine that? Now, if you look at my uptrend now, let me delete all this. What we are particular about for the uptrend is the highs, the higher high. As soon as the market is breaking the previous high, then you are having an uptrend. So now, how do you use the market structure to know whether a trend is continuing or not? So when the price break the previous structure, as we have it here, this is a structure, a resistance. The moment the price breaks this resistance that we have here, then we say we have an higher high. So when it breaks it, we say we have an higher high, and that gives us an uptrend. Okay, so that is how you determine an uptrend. When a price breaks the structure, the price breaks the structure of the previous high to create a new high, then we have an uptrend. Now, for the downtrend, for us to know the downtrend, when the price breaks the previous low, as we have it now, we have a low here, a pullback, then it breaks this previous low that we have here. The moment the price breaks this previous low, then you say we have a lower low and the market is in downtrend. So for you to know, use the market structure to determine the uptrend or the downtrend, you need to have two highs for the uptrend and two lows for the downtrend. What do I mean? Like, for example, for the uptrend now, you have a low, higher high, higher low, higher high. So this 1, 2, 3, 4. That is when you can join two. When you can join two lows together like this. Excuse me. Let me use When you can join two lows together like this, then you have a trend, an uptrend. That is the two lows, the lower low, the higher low, the higher high, the higher low. The moment you're able to get, so you say the trend has started. For the downtrend, the moment you're able to join two highs together like this, that is the lower high, the lower low, the lower high. The moment you're able to join two highs together, then you have a downtrend. Remember, two lows starts an uptrend, while two highs starts a downtrend. Okay, so that is how you determine the direction of the market to know whether you are to buy. And when you have an uptrend, what do? You buy. When you have a downtrend, what do? You sell. So that is the first thing you need to understand as a forex trader before you can click whether you buy or sell. You need to know the direction of the market first. And with the help of the market structure, you are able to know the direction of the market. So now, how do you know whether trend will continue or it will reverse? How do you determine that using market structure? Now, if you look at this now, here I have my higher low, higher high, higher low, higher high, higher low. And here I have a failure swing. So here I have a failure swing. The moment the market cannot create an higher in an uptrend, market cannot create an higher high. That means there is a potential reversal. So the moment market cannot create a new high, a potential reversal is looming. You know, here there is a break of structure here. This move broke this structure, created a new high, pull back. But the moment it couldn't create a new high here, then you should be watching out for a potential reversal. The same thing for the downtrend. When you have a lower high, lower high, lower low, lower high, lower low. The moment the market cannot break this guy, let me correct that. So the moment the market cannot break this trend line here, that means there is a potential reversal. For a continuation, market must be able to break that structure. The moment market is unable to break a structure, that means we should be watching out for a potential reversal. But when market breaks the structure like this, before reversing, before pulling back, that means there is a continuation. There is a market called price continuation or trend continuation. But the moment is unable to break the next high or the previous high, that means there is a reversal. But when it's able to break this previous high we have here, that means there is a trend continuation. So that is how you use market structure to determine the direction and the trend of the market, direction of the market, the trend continuation and trend reversal in the market. So now, so if you look at this, is the beginning of this trend, okay, of this Euro USD. If you look at this guy, that started from here as the higher low. Now, how do we determine whether this Euro USD now is in an uptrend or a downtrend? We start from the beginning, from the left, okay? Then you look at the first low. This is higher low. Then this is higher high. We have another higher low here. Then we have another higher high. So the moment you have higher low, higher high, higher low, higher high, then we have an uptrend. So this market now is in an uptrend. So before you can say this trend has changed now, there must be a break of structure to the lower side. Like for example, when this market reached this place, when it created this lower low here, and it got to this place, it couldn't break this structure to create a new high. So at this point now, we can say we have a trend reversal in this place, because since it cannot create a new high, it couldn't break this structure. So this is a potential at this point now, this high here, we have a potential reversal. But we can't say at this point that we have a reversal until this structure down here is broken. Until this structure down here is broken, that is when we can say we have a reversal. But now if we look at it now, that this trend here, this low here was broken. So the moment this low here was broken, that means we are now in a downtrend. And you can see that market has beginning to print lower high, lower low, lower high, lower low. So the moment you have two highs, two low, then you have a change of trend. So for this one now, we have here a change of trend here. The moment it breaks this low here, we have a change of trend. After this pullback, then the market trend direction has changed already. So this Euro USD now is now in a downtrend. You can see it has not beginning to print higher, lower high, higher high, higher, lower high, lower low, lower high, lower low, lower high, lower low, lower high, then another lower low. So for this one now, we are in a downtrend already for Euro USD. So Euro USD now is in a downtrend. So that is how you know the direction. But it is currently pulling back now. So it's currently call this one retracement, pulling back. But this market is in downtrend already. So any opportunity you want to be looking out for now in this market is sell. So that is how to use market structure. And for the other one, this is for downtrend now. Okay, we have the uptrend there, we have the downtrend there. So when you have a market printing higher highs, higher low, higher high, you have an uptrend. But when you see it printing lower high, lower low, lower high, lower low, lower high, lower low, and so on, you have a downtrend. So that is all you need to know about market structure, and now you can use it to improve your trading, because that is what is going to give you the direction of the market, and for you to know whether the trend is going to continue or reverse. So like for example now, since this guy here now has broken this previous low that we have here, that means this trend is continuing. This downtrend is going to continue, because this has confirmed this trend downward, that this downtrend is going to continue. So far it has broken this low that we have here. So far market has broken this low. So this downtrend still continue until we get to this final stop here. So far it has broken the previous structure here. So the downtrend still continue here. So what the market is doing now is retracement. So until it breaks this structure here, this structure we have here, we are not yet in an uptrend. So far the market has not broken this. Unless the market break this structure we have here, that is when we say, okay, we are resuming an uptrend. But so far, the market has not broken this one. We are still in a downtrend because this has confirmed the break of structure here has confirmed the downtrend, and the downtrend is still continuing. We have a downtrend continuation. So any opportunity you want to look for in this Euro USD will be sell opportunity, sell opportunity. If there is going to be any buy at all, it's going to be a short buy. Okay, so here on Euro USD, I say we are still in a downtrend. So thank you for watching this video. Bye bye. Hello. In this video, I'll be teaching on how to draw trend line properly to physically reaffirm trend direction. You know, in forex trading or in any financial markets trading, knowing the trend direction is very, very important, because the moment you fail at this phase, you will fail the entire process. And for you to be successful in forex markets, especially, knowing the direction of the trend is key to your success. So when you get the trend direction right, even when your execution is wrong, that is when you make mistake during your execution or during your entry, you will still be able to manage the trade. As in, when you get the trend direction right, where you are in the direction where you trade in the direction of the trend, even if your entry is wrong, if your execution is wrong, you will still be able to manage the trade and get out of it. But when you get the trend, when the trend direction is wrong, when you don't get the trend direction right, you have failed already, and there is no way you can make anything out of that particular trade. So for you to get this right, you need to first understand the structure of the market. So you need to first understand the structure of the market before you can draw a correct trend line. If you don't understand the structure of the market, of the instruments you want to trade, drawing a proper trend line might be difficult. So you need to understand, first of all, understand the structure of the market. So if you have not watched my video on market structure, for you to have the perfect understanding of what I'm about to teach now, you need to go and watch it. And you also need to watch the video on foundation of forex market analysis. So you need to watch those two videos, most especially the market structure, for you to have the perfect understanding of what I'm about to teach here. And again, you can subscribe to my channel so that you can get notification as soon as I upload the next educational video on forex trading. So now let's continue. How do you draw your trend line to reaffirm the direction of the market, whether the market is going up or is going down, for you to be able to know whether you are to sell or you are to buy? So now if you look at my screen now, you will see the price movement, you know, of GBP USD, you know. And don't forget, we have two types of market analysis. We have technical and fundamental, and under technical we have price action. So what we're about to do now is price action. So you use trend line in price action analysis. So now, how do you draw your trend line properly? For you to draw your trend line to reaffirm the direction of the market after you have seen the structure of the market. And briefly, let me quickly take you to structure of the market. I mean, to market structure, the summary. But if you want the details, go and watch the video. If you look at the beginning of the trend here from the left, you see this is lower high, lower low, lower high, lower low. So in the case of downtrend, when you have lower high, lower low, lower high, lower low, lower high, lower low. So for the downtrend, when you're able to join two lower highs, we'll say the trend has started. But when you are able to join the three together, then we'll say the trend has been confirmed. So for the uptrend now, when you have low, high, higher low, higher high, higher low, higher high. So when you're able to join two together like this, we will say the trend has started. But when you're able to join three, then we'll say the trend has been confirmed. That's the third one, confirmed trend. While the first two begins a trend. The first two begins the trend, while the third one confirms the trend direction. So for the uptrend, you join two lows together to start a trend. The moment you're able to find two lower lows and join them together, then you have seen a trend direction. But when you're able to join the third lows or the third low, then we have trend confirmation. For the downtrend, when you're able to join two highs, we say the trend has started. When you're able to join the third one, then we say the trend is confirmed. That is how to draw the trend line. When you use market structure, it's not so clear. But when you now use trend line to join it together, then you can now see clearer the direction of the market. You can see the trend line is going down. That shows that the market is the market direction is down, is downtrend. So for you to physically know the direction of the market, that is when you make use of the trend line to join your highs and lows together. Okay, so now let's look at how we can properly join the trend line, because there is a way to join the trend line properly. When you come to the chart, you don't just draw it anyhow. When you want to draw a trend line, you pick the wick of the candle, the highest wick of the candle, not the body. Some people pick the body, but I don't use the body. I use the wick of the candle, the top of the wick, like that. If I zoom in, you can see that I use the top of the wick. So I can adjust this one as well to use the top of the wick. I'll make sure I use the top of the wick. You don't use the body of the candle. Make sure you use the wick of the candle, so you can adjust your line properly to make sure you pick only the wick and not the body. So the moment you pick the body of the candle, you have violated that trend line. So like this one now, you can say this is a perfect trend line, okay, which shows the downtrend of the market using trend line. But now, how do you properly draw this? The moment the price has broken a trend line, that trend line is no more useful. So you need to adjust it. So assuming the market was at this point, the moment it breaks this, then that trend line is no more useful. So you pick the outermost candle or the wick of the candle. That is how you draw your trend line. So you pick the highs, all the possible highs that you can pick, the wick of the possible highs. in downtrend like this. Now 1, so I'm able to pick another one, 2. So with this trend line now, this has shown that we are in downtrend in this market. So this has shown us that we are in the downtrend in this market. This particular market is downtrend. So even if you use market structure, then you cannot use your trend line to reaffirm the direction of the market. So you can see now that it is obvious, even if you are wrong with your market structure that says this is lower highs, lower low, lower highs, lower low. With this too, it has shown that the market is in the downtrend. But if for you to now confirm, you cannot use the trend line. So looking at the trend line physically, you can see that it's downtrend. So this has reaffirmed that this market is truly downtrend. Okay, so that is how to use your trend line. Then there are other trend line that you can draw. This one we have currently now is called the external trend. So you can also draw internal trend. You know, I'm drawing this trend line on the monthly, and you don't really trend on the monthly. You only use the monthly to know the direction of the market. Then your execution will be on the lower time frame. So how do you use this trend line, you know, to get your execution on the lower time frame? So you can pick as many that you can pick here. The external you can pick on the higher time frame. You can see that I'm able to pick another higher highs now on this monthly time frame, picking the week like that. You can see that I'm able to pick another 2. That means the market is still downtrend, because sometimes on the higher time frame you might have an uptrend, but on the lower time frame you have a downtrend. Okay, so for you to be able to affirm that, you need to draw your trend line. Drawing a proper trend line is very, very important in market analysis. So if I go to lower time frame now, let me see if I can still draw another internal trend line. So I'm going to weekly now. So this is my weekly time frame now. So I can adjust the trend line to make sure it touches that. So this is my weekly now. So from here now, you can see the second line here of the external one. I can pick another highs that I could get there. Another set of highs. As I'm able to pick 2 now, 1, 2. That means there is another downtrend there. So I can continue on and on till I'm able to exhaust all those lines. So with this now, there is no other line that I could draw. So with this, I can see that I'm properly on the downtrend. And what we are having currently now is retracement. And if this current price now, or the market, is able to break this current trend line, if it's able to break this trend line now, then we'll say this particular trend line, this internal one, has been destroyed. So this is an external trend line. This is an internal trend line. This is another internal trend line. When an internal trend line is destroyed or broken, then it will go and meet the next external one. So that means this one will no more be useful. Like for example, now you can see that we have another one here that we can draw. But this one is already destroyed, this internal one. So we call all this internal trend line. So you can see that this internal trend line is already destroyed. So it's no more useful. There is no need putting it there again. So this is the one we need to focus on. So for you to know the proper trend direction of the market, so you need to draw your trend line. So if you're able to get it right at this level, then you won't have so much issue. But if you fail at this level, you're going to fail the entire process. I'm telling you. So you need to get the trend line, your trend line drawing. Drawing your trend line, you need to get it right at the beginning. So if you're able to get it right at the beginning, then the whole process will be simple. So this is how to properly draw your trend line. So this the same thing for uptrend. The one we are drawing right now is for downtrend. So if you want to draw for your uptrend, what do? You pick from the low, that is the higher low, to the higher high, higher low, higher low. If you're able to pick some lows together, at least two lows. If you're able to pick two lows, you have one here, you have two here. Or let me use this. This is the last one. This is the most external. So you're able to pick one, you're able to pick two. So we say we have uptrend here. On the lower time frame, we are running an uptrend. But on the higher time frame, we are running a downtrend. So if you're able to pick two, one, two, then you have a trend. Okay? So two start a trend, while the third confirms the trend. Now, how do you properly draw a trend line? You pick the wick of the trend. The wick of the candle. The wick, not the body. If you pick the body like this, you are wrong. But you need to pick the wick. That's how to properly draw a trend line. So if you're able to know the trend direction, like for example, now if you want to trade on lower time frame, using 4 hours now, where I draw this trend line, you don't have business. Since your trend line has given you this, you don't have business selling. All you need to be, except there is a change of trend. If this trend line is broken now, then you can now begin to think of trading, looking for sell opportunity. But in as much as the trend line has not been broken, you have no business looking for a sell in this lower time frame. But if you go to the higher time frame, like the weekly, for example, you can see we have downtrend. So you have no business trying to buy, except when this line is destroyed. Like for example, now this one has been destroyed. You can be looking for a short buy here. But since if you look at this trend line, it's about to hit this trend line. That means, except unless it break this trend line now, the market might reverse from here. You understand? So that is why it's very, very important. You can see that is the reason why the price has been struggling in that place, because of the trend line. It's hitting the trend, not until it's able to break that trend line. That is when you can have an uptrend or a buy opportunity. But while it's still testing that trend line, there is nothing you can do, than to just wait and see what is going to happen. Okay? So, or if you want to look at this one, you might say, okay, it has broken this trend line, then it's coming to meet this one, because this is the current highs that we have here. It's just creating this new high. Here is the current one we have. So I think this should be the correct trend line. That means it has broken this trend line. So it's coming to this next internal trend line. So we might have an uptrend here. A buy opportunity here. But meanwhile, this is a retracement, a buy retracement. This is not the trend direction. We call this one counter trend trading. So if you are trading this, you are doing counter trend trading. You are trading against the trend. The real trend direction is downtrend. But if you want to trade counter trend, you want to trade against the direction, then you will know that you are trading against the trend. Then you need to lower your risk and all that, because that is not the trend direction. If you are not careful here, you lose more money while trading against the trend than trading towards the trend direction. So that is how to properly draw your trend line. And I'm going to summarize what I've said. I said, if you want to draw a trend line for a downtrend, you make sure you pick at least two highs. Okay, make sure you pick at least, let me go to the monthly. So for a downtrend, make sure you pick at least 2 highs. That is lower high, lower lows, lower highs, lower lows, lower highs, lower lows. So you make sure you pick at least 2. If you're able to pick at least 2, then you say you have started a trend. Then the third one confirms it. Then when you are drawing the trend line, to properly draw a trend line, you must pick the wick of the candle. All the wicks, not the body of the candle. You draw your trend line picking the wicks of the candles, not the body. I repeat, you pick the wick and not the body. That is how to properly draw your trend line. So thank you for watching this video. In this video, I want to teach about demand and supply trading. Demand and supply trading. And I'm going to expose a lot of things to you in a simple way that you're going to understand. I'm very sure it's going to take your trading to the next level if you can watch this video to the end, because I'm going to expose a lot of things to you in a simple term concerning demand and supply trading strategy. Okay, so now, and if you have not subscribed to this channel, you can quickly do that by clicking the subscribe button below, so that as soon as I upload the next educational video, you'll be able to get notification immediately. And if you also have any question or comment, please drop them in the comment section below, and I'm going to respond to you. So now to the main business. What is demand and supply? In a simple and technical term, demand is when the buyer steps into the market to buy a particular asset or currency, while supply, on the other hand, is when sellers steps into the market to sell a particular asset or currency. In other words, you buy at a demand and sell at a supply. So you buy at a demand. These are the demand that you are looking at here. This is a demand, and so on and so forth. So you buy at a demand and you sell at a supply. Also, supply, on the other hand, here we have a supply. Here we have another supply. Here we have another supply. I'm going to explain that in details in the next couple of minutes. So how do you leverage on this as a forex trader or financial market trader? Because you can use it for all financial assets. So how do you leverage on this to take your trading to the next level? So you leverage on this as a forex trader or financial market trader by identifying the demand level where the buyers are waiting to buy. Where the buyers are waiting to buy, for you to also join the buy, or identify the supply level where the sellers are waiting to sell, for you to join the sell. So you identify the demand level. As a trader, you identify the demand and supply level, and those are the areas where we have buyers and sellers in the market, for you to join in the direction. You know, in forex trading or financial market trading, we always say trend is your friend. So when you're able to identify the points where buyers are buying, so that is where you also be waiting to buy, so that as soon as the the buys are triggered, you also join the buy. And also selling on the other hand, you identify those areas where we have presence of sellers, okay? So that as soon as the sales is triggered, you also join them in the selling. That is when you will see a massive move in the market. So when you are buying, when the sellers are in the market, you're going to lose your money because you'll be working against the trend. And also when you are selling, when there are presence of buyers, when there are buyers in the market, you're going to lose your money because you'll be working against the trend. Now, looking at my screen now, let me show you those areas where we have our demands and supply. Okay, so that you know the areas where you're also going to place your order for you to, leverage on this to take your trading to the next level. So if you look at the left hand side now where my cursor is, the picture we have on the screen now is a pure market structure. So if you don't understand market structure, that means this training is not for you. You will need to first of all go and learn about market structure, and I've done a video on that. Okay, I've done a video on market structure that I've explained market structure in a simple way. So you need to go and watch that first. So now, if you look at my left hand side here, you will see we have a low, a high, a higher low, rather, higher high, higher low, higher high, higher low, higher high, higher low, higher high. That is how we form a trend in the market. You understand? That is how you form a trend in the market. When you are making higher highs, higher lows, or lower highs or lower lows, that is how you form a trend. That's how you know whether you are in an uptrend or you are in a downtrend. So from this left hand side now, we are in a uptrend. So now, how do I locate my demand level here so that I can join the buy when the buyers are buying? Remember, I told you, you buy from the demand and you sell. You buy at a demand level and you sell at a supply level. So now, like I said earlier, if you look at this very point, let me use my, if you look at this very point here, this point, that is your demand. So when the markets move from a low to a high and pull back, it creates a demand. So it's on this pullback that we have buys and that we're going to have buying orders. So when you pull back, wherever you pull back to and take off again, that is where we have buying orders. It will be this, it is the buying order that will make the market to begin the move again. So this is your demand. So when the market is moving like this and it gets to a level and pull back, that is the leg that you're going to watch for you to buy. That is where we have the presence of buyer. That is your demand. So when market moves up and break this particular level, a particular level, like for example, this one where I have my cursor now, this particular level where I have my cursor now. So we call that a break of structure. So as soon as you break a structure and pull back again, you now look at the leg where you are pulling back to. When the market is pulling back, it's pulling back to a demand. So now, for example, some people, they might sell, the moment they see the market coming down like this, they might begin to sell from here. No, you don't do that. If you do that, you are working against the trend. You are not supposed to sell there. You are only allowed to sell at a supply level. But when after the market has pulled, has made a move like this and pull back, you watch the leg is pulling back to, it must pull back to a demand level. So when the market pull back to a demand level, as a supply and demand trader, that is where you will be waiting, because that is where the orders are. As soon as the market moves, it is the order of people, of traders here, that make the market to move. But when the market moves like this, all the orders are not executed at once. The big guys, they don't execute all their orders at once. There will still be so many orders left at this point. So the market is still coming back there to come and execute all the orders that we have here. So when the price pull back to that particular demand level, that is where you join the move, and that is when you will see a big move in the market. So I will go to repeat that from this low here, we have a high, we have a higher low, we have a higher high. So this higher low, when there is a pullback from here, this is where your demand is. Okay, this is where your demand is. Or let me use this is your demand level. So you'll be waiting for markets to pull back to this demand level before you join the move. Okay, you don't buy at the middle here, except you are a demander, support and resistance trader. That is when you can buy here. But I'm not teaching about support and resistance now. I'm teaching about demand and supply. So as a demand and supply trader, as soon as there is a move in the market, the impulse leg, we call this impulse leg. As soon as you have impulse leg and a pullback, is good. Wait for you to pull back to a demand level where you have the presence of buyer, then you join them to buy. That is when you're going to see a massive move, a massive impulse leg again. So after that massive impulse leg, then the moment there is also a break of structure, then you'll be expecting a correction again. You have impulse leg, you have a correction leg. So you'll be waiting for that correction leg again to move to another demand level before you start the buy again. Like for example, this level, this points, we call this one a support and resistance. After a break of structure and there is a pullback to the previous levels here, this is a resistance. When you have a pullback to the previous resistance, then we call that place support and resistance, because it's not using that place as a support before moving on. But like I said, I'm not teaching on training on support and resistance today. What I want us to focus on is demand and supply. So this is your demand level. As soon as you have a pullback to that, you join them from here. There is an impulse move here, a correction, then the market continues to move like that. So as soon as we have another break of structure from here, you wait for another pullback to your demand level. So this is another demand level we have in the markets now. This is another demand leg we have in the market right now. I hope you understand that this is one demand leg, a break of structure, a move, a correction, an impulse, a correction, an impulse move, break of structure, pulling back to a demand level here. At this point where you can see my cursor here, it's pulling back. When this leg is pulling back, pull back to that leg and it moves. Then the price continues to move like that until it pull back to that demand level again. Okay, this is another demand level in the market. You might be asking the question, okay, what of this one? This one is not a demand level. This one is a liquidity. When you have a move, there must be a break of structure, okay, before you can approve a demand, because before a demand can be approved as a demand. From here now, you have a pullback, there is no break. This one does not break this particular level. This is like a correction, before there is a real move here. So when you have the real move, where is the starting point of that move? That is where you consider that is where I consider as demand level. So where we have the starting point of that move, also that is where we have another demand level. So that is how you identify demand level in the market. Here we have a demand level or a demand zone. Here we have another demand, and that is the only place you are allowed to take a buy from. You don't sell from that area. That's where in a not trend, you buy after a pullback. You buy after a pullback, after a pullback, you buy. Let the market move. After a pullback again, you join the buy again. After a pullback to the demand level, you join the buy again. So that is demand. Now to the supply, when you look at this price from here, this is a demand has been created from here. Another demand level has been created from here. So when you have more than one demand level, more than one demand on a single level, we call this demand zone. So that means a demand zone has been created from here before we have this move. So now, after we have the move up to this level, okay, we have a pullback here. Now there is no swing high again from here. Here we have a swing failure. There is no swing high again. And we have a pullback that broke this particular structure here. So the moment a structure is broken to the other side of the trend, we were coming from an uptrend. Now we break to the downtrend right now. We call this one change of trend. I call it change of trend. The SMC trader, they will call this change of character, but I call this change of trend. I call this swing failure. Some people will call this one double top. The pattern trader will call this double top, but I call this one swing failure. So when you have this swing failure or double top, and you have a break to the downside like this, then we have change of trend. So now, the moment you have a change of trend, then the direction of the market is changing already from an uptrend now to the downtrend. Okay, it's changing from an uptrend now to the downtrend. Now, in downtrend, what do? You look for sales opportunity. How do you look for your sales opportunity? How do you leverage on demand and supply to look for your sales opportunity? Then you do that by looking out for your supply level. In a down sell, you look for supply for sales opportunity. Then in an uptrend, you look out for your demand level for buy opportunities. So now that we have a change of trend to the downside right now, as soon as we have a pullback to this place, then you have a move again. You have a break of structure here. Then you wait for a pullback to your supply. This is your supply level now. This is where you are to look for sales opportunity. This place, this is where you have to look for sales opportunity now at this point. You don't sell from here. You don't even sell from here until you have a break and pull back and the market is pulled back to this supply level or move back to this supply level. This is your minor supply. This is your major supply. In the market, you can have a minor supply, you can have a major supply, you can have a minor demand, and you can have a major demand. So as soon as you have a change of trend, you pull down, a break, pull back, okay, another break again for breaking of structure. So the moment you pull back to this supply level or this supply level, this is the only place where you are entitled to, take a sell, because those are the area where we have the presence of sellers. So as soon as you have this impulse leg and a pull back to hit to that level, that is your supply level, then from here, you take a sell, because that is where you have the presence of the sellers. So as soon as the market pull back to that, the sellers are waiting here for the market to actually pull back to this place. So as soon as the market gets to this place, using your entry strategies, I need to say this, I didn't talk about this while we're talking about demand, but I need to talk about it now. You don't just jump in because you see a supply level or a demand level. You need to use your entry strategy. This one that we are doing right now is analysis for you to know where to buy or where to sell. But after you have been able to identify the location, whether a demand location or a supply, then you now need to use your entry strategy. So as soon as the market pull back to this supply level, then you will now do what? You now need to look for use your entry strategies, before you can take a sell here. So as soon as the market pull back to this level, then you use the entry strategies or entry confirmation. You don't just jump in for a buy or sell. You need to confirm, because sometimes it might get there and it just blow off, to go and test the next demand. Like I said, we have minor supply, major supply. So you might just not respect this price. If you don't have enough sellers here, it might not respect that level to go and test the next level, where we have the where we have presence of a lot of sellers. That is where the market is going to turn back. So, but when it gets to this place now, if we have enough presence of sellers there, you see the market begin to drop again. So the moment it drop again and we have a break of structure here, and it break this particular level here, it's going to retrace back again, to another supply level. Then from there, you join the sell again. The moment there is a break of structure again, it's going to pull back. So it's going to create another supply level again, and so on. After a break of structure, it goes to create another supply level again, then move down and begin to make a move. But that's how you leverage on demand and supply in your forex trading. So now, after I've explained using this diagram, so can we now look at the live charts now, so that we can understand what we have been talking about since. Now, if you look at this live charts now, if you look at it from this point, you can see that from here, let's assume we start from here. We have a move to this point. From here we have the low, high, low, higher low, higher high, higher low, higher high, higher low. These are just a move. Markets move in zigzag. These are just a move, higher lows and high, that is created for market to continue its upward move. But on getting to this place, this high, you can, if you look at the left hand side here, we have a particular level here. That is a supply level. This market was coming from a downtrend here. From an uptrend. This is a supply level. So as soon as the market breaks that level, they pull back. But here it couldn't break this supply level here. The price was rejected from there. Then at this point, it was able to break it at this point. So as soon as it breaks this, when the price was rejected from here and make a pullback to this place, it has created a demand level there. So as soon as the price breaks, as soon as the price breaks that level, it has approved this demand that truly we have the presence of buyer here. So you will now wait for price to pull back to this particular leg now. So when price pull back to this, it might come immediately and it might take so long to come back. But when the price, one day, one time at a time, the price is going to come back to this particular level. This is a demand that has been created. At the moment it breaks this structure, that demand has been approved, that truly there is presence of buyer here, or there are presence of buyer here. So then you now wait for the price to come back to this level, just like the way it come back here, before you now take your buy. So as soon as the price breaks this level now, then it has created a demand here. So now on getting to this place, we have a pullback, then a move. Now we have equal high. We couldn't make an higher high again. It couldn't make higher high. From here we have equal high. That is a swing failure. Then we have a pullback, and at this point we have what? A break of structure. At this point we have a break of structure to the downside, which is a trend a change of trend or change of character. So now after that change of character, you know, there is a breakdown over here. Market pull back again. Okay, now at this point, it has created a supply. So we have presence of seller here right now. So you now be waiting for price to come back to that level. So now after we have a move down here now, you can see we have another break from there. So the moment the market break that level, so the next level you'll be watching is this particular level from here for price to move to. Sometimes it might get there like this one, sometimes it might not, but this is your supply level right now where we have presence of buyer. And I'm very sure one day, one time, price is still coming back to this level to come and fulfill all the pending orders that we still have here. Okay, sometimes it might not get there, sometimes it might get there, but one day, one time, it's still coming back. So it created another supply level here, and it breaks the structure, and you can see that price actually come back to this level right now. So that is your supply level. This is the only place where you need to, you know, look for sell opportunity. You don't just look for sell opportunity, although there are some tools, like I said before, that you can use, you know, to confirm where the supplies are, where the market is going to return or reverse. There are tools, there are patterns you can use, but if you have nothing, then you have to wait. This will be the level you are waiting for the market to pull up to before you can, the supply and demand trader, before you can make any move. So as soon as the market gets to this place, you join the sell there, then you see the market pulling down again, and you can see that it has broken another structure here. As soon as it breaks another structure, then it will go and create another supply, then continue to move, and so on and so forth. Then one day you see the market coming back to come and fulfill all the pending orders here. You know, you see after the market break this particular demand now, okay, like for example now, you know, we are in a downtrend here. This is an uptrend. We have a change of trend here, now in a downtrend from this side. There is a change of trend there, a downtrend now. Now at this demand level, this is really the only place where you can buy. And the buying here will be a counter trend buying. You understand? And that is why you see that the market did not respect that level. But you can see that it used that place as a resistance. So we call that place a flip zone. When the demand is violated and used and retested, we call that place. So if that place hold, we call it a flip zone. So you can see it breaks the demand level, use the place as a resistance, then the price continues to move downward and downward until you have a change of trend again. At this point right now, where my cursor is right now, you have a change of trend from that particular point. You have a change of trend, and you see the market begin to pull up and now begin to test all those supply that have been created. You know, as soon as the market gets to this place, it will test those supply to see whether they are pending orders here for the price to move down. But if there are no pending orders here, it will break and continue its move upward. But for the moment you change now, you know you are in an uptrend now. The trend has actually also changed, you know, and beginning to create demand. And demand, you see, creating demand here, creating demand here, creating demand here. So as soon as it's creating demand, this is where you'll be buying and buying. But when it pull back, creates a demand and breaks, it's going to test this supply, the next supply that is going to meet, like the way it happens here. You know, after creating a demand here, and there is a break here at this level, it tests this supply. This is the supply that has been created. You know, I remember I told you when there is a move, it's coming back to test those supply. And those are the area where you are entitled to sell or buy. So this supply level, this is the only area you can sell, not this place. You know, after a pull down here, a move up, you know, the market pull back again. Okay, like for example, here, this particular point, yeah, very good. This particular point here now, this particular point, you are not to sell here because this is not a supply level. We have a break. There is a break here.
but there is no supply here. So at this point here, you are not supposed to sell for this move down here. After a pull up, there is still no supply here because this is the previous high that was created, that was tested. Assuming this one is broken. So, but there is no supply here. You are not to sell here. Until this place, this is where we have a supply. If you look at my left now, there is a supply here. So if you want to sell at all, this is the only area level where you are to sell. Not here, not here. This is the only area where you are to sell in this uptrend. You understand? So, and as soon as it breaks that level again and pull back, you have another demand. Then you enjoy your buying from here and continue like that, and so on and so forth until you have a change of trend again. So, in summary, here you have your low, a break of structure, a demand is created, break of structure here, a demand is created, you join the demand. This is where you have presence of buyers. The price moves, getting to this place, pull back, assuming it was able to break this level right now, see this one as a new demand. But since it did not break it, there was a break change of trend here, it begins to create supply. So in a downtrend, you have supplies created where you do your selling. In an uptrend, you have demand created where you do your buying. If you have any question, please drop it in the comments section below, and I'm going to respond to you. Thank you. Hello traders. In this video, I want to quickly show you how to use your Fibonacci to confirm your levels in the market. You know, there are some levels that are going to hold, and there are some that will not. It's not all level that holds. And when the level is not holding, you're definitely going to have issue. Because if you think a level is going to hold and it's not, you're definitely going to have issue at that particular point. But how do you know a level that will hold so that it can give a full concentration at that level? So you can use that with the help of Fibonacci. So there is a tool called Fibonacci that you can use to confirm your level, to know whether the levels will hold or not. So how do you use Fibonacci to confirm a level, whether that level is strong or is going to hold or not? Then before I continue, if you've not subscribed to this channel, you can please click the subscribe button right now, so that as soon as I upload the next educational video, you'll be able to be notified immediately. So now, if I pick my Fibonacci tool to confirm this level, you draw it from a low, a previous low to a previous high, to confirm the levels in between them. Like for example now, if I draw my Fib from this level to this level, what do you see? There are some levels you consider on Fibonacci that would consider strong levels you need to watch, and they are 50% levels, 61.8%, then 78.6%. Those are the three levels. And how do you do the settings? If you right click on this now and go to settings, you will see all the levels there. You have them, there is a way you can set them here, although you're going to have them set for you as a default settings. You know, we have default settings here. They're going to set it for you, and there are some that you can remove if you don't want. Like I remove this 0.382 now because I don't use it. They are not key levels that really works. At this at 0.236, you can check or uncheck. If you check it, you can see that it has come there. If you uncheck it, you will see that it has gone off the place. Like this 3.82, I don't use it as well. You can see that has going to uncheck it, it's going to go there. So the levels I use, they are 61.8, 0.618. I use 0.786, then I use 0.5. 0.5 means 50%, 78.6%, 61.8%. Then okay, that is the levels that I use, and those are the ones that you are seeing on my screen right now. This is 71.8, this is 61.8, and this is 50% or 0.5. So when you draw your levels from high to low, you're going to see, so if that level is going to work, it's going to align with either of these this fib level. So if it's aligned, yeah, it might not be on top, exactly on top of it as we have it here. But if they are close, just with a little distance, then you are good. They might not be exactly on it. Like if you look at this one now, you can see, as I have it here, that this particular level that I draw here align with this 50%. So assuming this other candles from here has not been printed like this, as if they are not being printed, I will have more confidence at that particular level, because it aligns with 50%. But the lower they go in an uptrend, the stronger they are. 61% is stronger than 50%, while 78.6% is stronger than these two. So the lower they go, the stronger they are. So at this level now, this 50% now, I can consider this level to be a good level to watch. That is how you use it to confirm your levels in an uptrend. You draw it from a low, using your market structure. We have higher low, higher low. So if you want to draw it, you pick it from low to high in an uptrend. But in a downtrend, from low to high in an uptrend. But in a downtrend, you pick from high to low. Okay, in this downtrend now, let's use Fibonacci to check the levels from here to here. What do we have? There was a time the price moved from this way. After a break of structure, it moved here and it tried to retrace. You can see where it pulls back to 50% or 0.5. That means this level that you draw here is a good level. You understand? It's correct, since it aligns, or is in alignment with this 50%. You understand? And that is why you see that it's held and the price broke down from there. You understand? So that's how you use this. So from this place now, after the trend has changed from here, you can see we have a break of structure from here and go to this place, pulls back. When the price is pulling back from here, how do you know where this price will pull back to? That is where your Fibonacci comes in. So you draw your levels to this place, You understand? So be sure whether this level is actually going to hold. When you use your Fibonacci to test, you can see that when the price, at this point, you don't know whether this level whether there is a level here anyway. But this is the one that you see. When the price is coming back, you can see this place, this particular point. This is where you go to watch, that where you have your level. So as price is coming back, you can see that price actually got close to that place. After a break here, it pulls back, it breaks down, okay, created this structure, this supply, breaks down, and the price is retesting from here. When you draw your level at that particular point, you can now use your Fibonacci to test whether that level to work. So if there is alignment, you can see that we have our 61.8, you know, in that place. That means this level is a good place to watch. We'll actually draw this level. This is 50%, this is 61.8, but you can see they are close. So you can still consider this level, and that is why the price actually moved down from here. Now, I also want to test this level after this pullback. I want to know where this price will actually pull back to, for me to be sure whether those levels are correct. If you look at this point now, after a break of structure, the price actually moved down to this place. So, but when it was pulling back, it used this flip zone, you know, as resistance. Then price continued downward. So the moment price breaks this place, so this has become a new low that we're going to test. So the price breaks it again, it has not pulled back completely and comes to this place. So that means this is where we're going to test. So as the price is pulling back right now, where are the areas that we're going to watch from this high to this low? Watch this 50%, 61.8 and 71.8. And you can see when it gets to 50%, it then respect that 50%, even though the supply there was a reaction. It breaks the 61.8. You can see that there was a reaction there, but now at 71.8, you understand? And I think the place held, and that's why you see the price moving down. So those are the areas. So for you to know, if you say there is a level here, and that level is closer to this 78.6. So when it is closer like that, or it's aligned, then you need to watch that level, that point. So that is how you use Fibonacci to confirm your levels. So you draw from a low in a downtrend, you draw from a high to a low. Then you watch your levels, whether they are aligned, they are in alignment with the price, the levels, whether the Fibonacci levels, they are in alignment with the level that you have drawn, for you to be sure that those levels are correct. If they are in alignment or they are close, then you will know that those levels are correct. But if they are not, then you will know that there might be an issue at those levels that you might need to look at your levels again. So that is how to use your Fibonacci, to confirm your levels before you can make your decision whether you have to buy or sell, or you watch at that particular level. You may use that to make your decision, to watch the reaction of what's going to happen, so whether you have to buy or sell. Thank you. In this video, I'll be teaching on chart pattern. And what are these chart patterns, and how and why are they important? In fact, not just important, why are they very, very important to your financial market trading success? And those are the things I'll be talking about in this video. So I want you to sit, relax, and watch this video to the end, because there are so many things that I'm going to be revealing concerning this chart pattern, most especially the conception or the misunderstanding of some traders between support and resistance and double top and double bottom. So just watch this video to the end, as I'm going to be explaining all that and revealing all that to you. Now, these chart patterns, they are the information that the market presents to you for you to make your buy or sell decision. And they are everywhere on the charts for you to make your buy or sell decisions. Now, there are two main types of chart pattern. We have one, reversal pattern, reversal patterns, Then number 2, we have continuation patterns. Excuse me. Reversal patterns and continuation patterns. So what are reversal patterns and what are continuation patterns, and how do you use them? In reversal patterns, we have so many of them, but there are major ones that I usually use, and you find them most often on the charts. And they are 1, or let me put here, or 1, we have double top, we have double top. 2, we have double bottom. Sorry, double bottom. 3, we have head and shoulder. 4, we have inverse head, shoulder, inverse head and shoulder, or inverse head and shoulder. So those are the major ones that I use as a reversal, to spot that a trend is about to reverse. That is what reversal pattern does. Reversal patterns helps you to spot a reversal in the market, that this trend you are following is about to end. That's what reversal patterns does for you. And like I said, we have these 4 of them that I use: double top, double bottom, head and shoulder, inverse head and shoulder. At the top of the uptrend, or let me just complete them. So we have reversal patterns and we have continuation patterns. Then what are the continuation patterns that we have? The major ones. We have many of them, but the major one that I use is rectangle pattern. So this rectangle pattern is actually the only one that I use for continuation. We have many of them. We have channels, we have pennants, we have rectangle, and so on and so forth. But every other pattern, chart pattern, depends on this. Like for example, if you are using a channels now, whether rising channels or falling channel and all that. If you are using channel, for example, channels still work with double top, double bottom. Without double top, double bottom and all that, you might not be able to use channel. If time permits, I will explain that at the before the end of the video. But the major pattern that I use and that you need to understand the market, and if you're able to understand these patterns that I've listed here, is going to do a lot for you in the market. Reversal patterns, this double top, double bottom, head and shoulder, inverse head and shoulder, and continuation pattern, rectangle. So now, how do you leverage on this? How do you make use of these patterns? So for reversal patterns, you find them at the top of a trend, like this. That is double top. That is double top here. That is, you have the first touch here. Here's my marker. Here you will have a first touch, second touch at the top of a trend. When you have a first touch and when the market or the chart or the trend is unable to make a new high in an uptrend, that is when you have a double top. Did you get what I said? When you are in an uptrend and the price is unable to make a new high, then that is when you say you have a double top. That is, and this is usually found. This is usually found at the top of a trend. So when you find this pattern at the top of a trend, that is called double top, and that shows you that the trend is about to reverse. So the moment you see this pattern here, be preparing. If you have any position, begin to close them. The buy position, begin to close them. Then we call this place a neckline. So I'm going to explain later how you make use of them. So this is a double top pattern. Then a double bottom pattern, you usually find them at the bottom of a trend. Like, for example, you are having I think I should continue with this. You're having a lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, equal low, then break of structure. So the moment you have this in a downtrend, you have this pattern at the bottom of the downtrend, then we call it a double bottom. So the moment you are making a lower low, lower high, lower low, lower high, lower high, and it gets to a point, you couldn't make a lower low again, and you have an equal low. Then we call that place, that pattern, a double bottom, and that signals to you that the trend is about to reverse. So the moment you have an equal low, that the price is unable to print a lower low, that you have an equal low, then you should be preparing. If you have any short position, you should be preparing to get out of them, because the moment the price breaks the neckline, you have a reversal already. So as soon as you have this equal low, there is a reversal. There is a potential reversal, but this pattern is not completed until you have a break of the neckline. So I'm going to explain that when I'm about to explain how to make use of them. So that is double bottom. At the top of a trend, of an uptrend, you have a double top. At the bottom of a downtrend, you have double bottom. Now, the two of them, they are for, remember, I'm talking about reversal pattern, the patterns that tells you that a trend is reversing. So that is how you know that a trend is reversing, using chart pattern. So now the next one that I'm going to talk about is head and shoulder. Head and shoulder. If you look at this pattern that I'm trying to draw here, in an uptrend, you have low, high, higher low, higher high, higher low, higher high, higher low, higher high. Then all of a sudden, you have either equal low or a little break. Then you have lower high, then a lower low. So at this point now, we will say we have head and shoulder. If you look at this pattern here, at the top of this trend, is a reversal pattern that is called head and shoulder. And here we have the left shoulder, we have the head, that's why it's called head and shoulder. We have the head, and here we have the right shoulder. So that is why it is called head and shoulder, and it's usually found at the top of an uptrend, because the moment you see this particular pattern at the top of an uptrend, then you know there is a potential reversal. But the chart is not completed until there is a neckline break. So we call this place a neckline. A neckline. This is the left shoulder, head, and right shoulder. That's why it is called head and shoulder. And here we have a neckline break. So until the neckline, here we have a neckline. And until the neckline is broken, this chart pattern is not completed. So now the same thing on a downtrend. So when you're on a downtrend, you find that is where you find the inverse head and shoulder, as in like this. You have a high, low, lower, high, lower, low, lower, high, lower, low, lower, high, lower, low, then lower, high, lower, low. Then all of a sudden you have equal, either a little bit above, or you have equal, then you have this, then you have this. So anytime you see this in a downtrend, this signals a reversal, and this is our neckline. So neckline is very, very important in all these patterns. So when you have this in a downtrend, at the bottom of a downtrend, so this is a shoulder. These are the two shoulder, then this is the head. The left shoulder, the head, the right shoulder. So these are the two major, or the four major chart patterns that you have as a reversal pattern that you should be spotting out for when you should be spotting out for on a chart for your reversal. So we have double top, we have double bottom, we have head and shoulder, then we have inverse head and shoulder. The inverse head and shoulder is found at the bottom of a trend, while the head and shoulder is found at the top of a trend. Double top is found at the top of a trend, while the double bottom is found at the bottom of a trend. That is what makes them what they are. Remember, in the forex trading or financial market trading, we always say trend is your friend. So the moment you are seeing this at the top or bottom of a trend, you should know that the trend is no more your friend at that point, that you need to exit the market. Okay, then the next one that I'm going to talk about is the continuation pattern, which is the rectangle pattern. And this one too, you could find it anywhere on the chart, and we call it continuation pattern. And it looks like this. When you see a pattern like this, on the chart, we call this rectangle. So here you have a line. Here you have another line. Then how do you trade this? You trade this when there is a break out of either of these two. That is why we call it a continuation. But most of the time, you find this in a trend, in a trending market, that this is usually called consolidation. So when the market is trending and all of a sudden it begins to consolidate. So when the price is trapped in between two lines, that is, the market makers are yet to make decision whether to go up or to go down. And this can actually break either way. So when it breaks up, that means the market is going up. But when it breaks down like this, when it breaks down like this, that means what happened, the market is going down. That is a continuation pattern, a rectangle pattern, and is a continuation pattern. You usually find this in a trending market. You know, the market has been going lower, it's been going in a direction, whether if it's in a downtrend, it's been coming down, all of a sudden you see the market begin to consolidate. You know, they are using that time to make decision on whether the price should continue to go down or they want to reverse it. But before it is reversed, you're going to see a reversal pattern. But most of the time, this gives you a continuation. When you see this on the market, it's a continuation. But so you have to wait for a break. If you find this in a downtrend, and you see this consolidation, like for example, this, you find it here, up like this, you are in a downtrend, and it begins to consolidate, then you should be, preparing that there might be a continuation. They are just using this, to make a decision in the market whether they should continue on. But most of the time, there is going to be a breakout, and as soon as there is a breakout, what happens? You enter yourself. You enter yourself, yes, because this is a sell continuation. Then if you have it in an uptrend, that is, in an uptrend, you are having this. So when the price is coming, it's going in an uptrend, all of a sudden you begin to consolidate. The price begins to consolidate. Then you should be preparing that the price will continue. But sometimes it might reverse from there. But before it reverses, it's going to give you a reversal sign, not this rectangle sign. But when you see this rectangle sign, it shows a continuation of the price. Then what you do is you wait for a breakout. Then after a breakout, retest, then you buy. Remember, in a downtrend, consolidates, downward downtrend continuation. In an uptrend, consolidate, uptrend continuation. So that's how you leverage on all these patterns, to know when the price, to know when to buy and when to sell, to know what the price is about to do, whether there is a price continuation or there is a price reversal. So when you see a consolidation like this, then you should know what to look out for. When you see all this pattern, reversal pattern, then you should know what to look out for. Then how do you trade them? At least you're able to identify them now. This is rectangle. This is head and shoulder, inverse head and shoulder, double bottom and double top. Then how do you trade them? In an uptrend, when you see this pattern in an uptrend, you wait for a neckline break. As soon as you have a neckline break, what do? You enter yourself. This place will be your entry, while your stop loss will be at the top here. Your entry, the moment you have a break of this neckline and close, we call this place neckline. This black line, we call it neckline. So the moment you have a break of that neckline and close, then you have your entry here, then you place your stop loss above here. The same thing in a downtrend. The moment you have your double bottom like this and the neckline here, so you wait for this neckline to break. As soon as this neckline is break and close, remember it must close. If it does not close, then you have no pattern yet. It must break before you have a pattern. The pattern does not complete. This pattern has not been completed until you have a neckline break. So as soon as you have a neckline break here, what do? You enter your sell and you put your stop loss under here. Okay, the same thing with head and shoulder. In an uptrend, the moment you sight this in an uptrend, what do? You wait for a neckline break. You've seen the left shoulder, head, right shoulder. Then you wait for a break of this neckline. Okay, the moment this neckline is broken, this is the neckline. The moment this neckline is broken and close, what do? You enter your sell position here. You put your stop loss above here. The same thing in a downtrend. The moment you are able to sight this in a downtrend, what do? You've seen the left shoulder, head, and right. You wait for a neckline break. Your neckline is here. The moment you see this neckline break and close, the candle must close above it here. If the candle does not close, that is invalid. But for it to be valid, it must close above. So the moment the candle close above this, what do? You enter your buy and you place your stop loss below this place. That is how to trade patterns. Then for the continuation, you are coming from an uptrend, from a downtrend, and you begin to see a consolidation. What do? You wait for a break. Most of the time, break to the downside. You are coming, is a continuation coming from up. You wait for a break towards the downside. As soon as the candle breaks and closes here, you enter your sell, put your stop loss above here. You put your stop loss above here. You're coming from a downtrend. Break your entry, your stop loss. You are coming from a downtrend, from an uptrend rather. You are coming from an uptrend. You meet a rectangle. You are able to spot a rectangle pattern. What do? You wait for a break. The moment you have a break here, what do? You enter your buy here, your entry, then you place your stop loss below here. That is number one way to trade all those things. Then there is another way to trade them. When you spot a double top pattern like this, you can wait. As soon as the candle breaks the neckline, the price breaks the neckline, you wait for a reversal. You wait for a retest, either to retest this neckline. If the retest hold here and continue before you enter, or you wait for it to retest. Just wait for a retest. Then the moment it's retested, but breaking is very important. Break, wait for a retest. The moment it has retested, then you enter your sell, so that you will be able to reduce your risk. The same thing in a downtrend. The moment you spot this and there is a break, wait for a retest. When you wait for a retest, it can either stop here, use this place as a resistance, or it comes to this around here. Then you enter your buy from here. You still place your stop loss below here. There is a way to trade that. So when it's retested, you wait for a bullish momentum candle. The moment you see a bullish momentum candle, you enter your buy. place your stop loss here. That helps you to reduce your risk. The same thing here. You see a candle break, wait for a retest. The moment you see a bearish momentum candle, enter your sell, place your stop loss, and with that you're able to reduce your risk. The same thing for the head and shoulder. After a break, you wait for a retest. Instead of you entering immediately and you place your stop loss there, you reduce your risk by allowing it to retrace. The moment it retraces and you see a bearish momentum candle, you enter, you place your stop loss here. The same thing here. After a break, allow it to retrace back. Then after you see a momentum candle, a bullish momentum candle, what do? You enter your buy and place your stop loss here. So with that, you are able to reduce your risk. Because, like for example, this one, if you enter here as soon as there is a break here, if you're having 50 pips here, 50 pips stop loss here, but when you allow it to retrace to like half here or to wherever you say bearish momentum candle, it might have reduced to 20 pips, it might have reduced to 30 or 15 pips. So that is just the essence of that. Then for this rectangle as well, what do? As soon as you see a break, like I said, you enter, but you can allow it to retrace as well. Retrace back to this level to use this place as resistance. As support, as resistance, yes. Or it retraces back into this place. Then after some bearish activities here, you enter, you place your stop loss, and with that, you're able to reduce your risk. The same thing here, coming from you are in an uptrend, you meet a consolidation. After a break, instead of you to jump in immediately that you have a higher risk, you can allow it to retrace. Then after it has retraced, either use this place as a support or retrace back inside this place and you see some bullish momentum here. You jump in. With that, you're able to reduce your risk. So that is how to trade patterns. We have seen the reversal patterns and we have seen the continuation pattern. So now let's go to the charts to cite some examples of these patterns. Like the first one that you're going to see here is, this is it. So if you are like this now, Euro USD is about to fall with this pattern that I'm seeing on the chart right now. What do you see here? Double top in an uptrend. Is this not an uptrend? You see a double top. This is an uptrend. Okay, a double top, a neckline. This shows that the price Euro USD is about to fall. So this market is going to fall because it has broken the neckline, and you can see that it's dropping already. You can see that it's dropping already. Then, if you look at this one again, this is another double top, still in an uptrend, and this is your neckline. What happened? After the neckline break, you can see the fall here, from here to here, 82 pips. You see it? Where did you see it? At the top of an uptrend. That is double top. Now let's go and look for double bottom. Double bottom. Look for double bottom example. Where do we locate double bottom? We locate it at the bottom of a trend. We locate it at the bottom of the trend. Like this one now, this is a double bottom. We are coming from uptrend from here. Or let me look for another better one that better explains it. Like, for example, this is an head and shoulder. We are coming from a downtrend. At the bottom of the trend, you have your left shoulder here. You have your right shoulder here. You have your head here. And this is your neckline. And you can see after a break, what happened? Price move up. You can see this is example of head and shoulder. I believe you still remember while I was my explanation concerning this. So you can watch the video again, that this is inverse head and shoulder. To get my explanation, you can watch the video again. So I'm looking for another one. We have seen double top, we have seen inverse head and shoulder. So I'm trying to look for more of them. Trying to look for more. I'm trying to look for more, especially the head and shoulder and double bottom. Same inverse head and shoulder. I'm looking for head and shoulder and double bottom. Now, this is an example of a double bottom. Where did you see it? In a downtrend. What do you have here? A double bottom coming from a downtrend, and this is your neckline. What happened after the neckline break? Although we still have this long tail, this is deceptive kind of. So here, and that is why you see that this price still come down here. So you can watch here, then you can also watch this place. So if you take this place as your neckline, a break, a retest, then a move. If you take this place as your neckline, what happens? This is your break, and that's why you see the move up. You understand? But this is a double bottom, an example of a double bottom in a downtrend. So those are the reversal. Okay, those are the reversal pattern. Then we have seen double bottom, we have seen double top. We have seen double top. Can see that it's moving already because of this reversal here. You know, in an uptrend, then you have this reversal, so it's dropping already. So I'm looking for, this is also, this is an example of head and shoulder. You have the left shoulder, the head, and the right shoulder. Then this becomes your neckline, although sometimes neckline could be bent like this. So this is your neckline. So as soon as you have a break, what happens? Your entry, your stop loss. You understand? So your entry, your stop loss, and the price begin to drop. So that is, you've seen a reversal, you've seen head and shoulder, you've seen double top, then we've seen double bottom. We've seen double bottom. Okay, then we have also seen inverse head and shoulder. Here is that inverse head and shoulder. We have seen inverse head and shoulder. So that is how you spot them. So anytime you see all those patterns in the market, they are telling you something. They are giving you information on what to do. So now let us look out for a continuation pattern. Now a continuation pattern. A continuation pattern, that one usually a continuation pattern like this one now in a downtrend. What happened here? You have a consolidation here. You can see that the price is not making a new high or low from here until there is a break. You can see from here no new high, no, until there was a break here. This is an example of a rectangle. Can't you see that is in the rectangle now? See, the moment it enters this box, begin to consolidate, moving up, moving down, moving on till there was a break here. And what do you have? Continuation. Okay, what do you have? Continuation. So that is an example. So you can spot many of them. All you need to do is just for you to practice very well, for you to be able to spot this, for you to be able to spot those patterns. So they are there everywhere on the chart to give you some information on what and what you need to do. So when you see them, you're able to spot them and you know how to trade them. They are going to take your trading to the next level. So that is all yes, and there is something that I would like to say concerning all these patterns. Remember, I said something about knowing the difference between when you have a pattern or when you have a support, because many people, let me explain that on the Euro USD, because many people, they mistaken a pattern with a resistance. Like for example, on this AUD USD now, on this AUD USD, if you look at this place, I am not going to take this one for, some people will take this for double top. Yes, it's a double top, isn't it? It's a double top. But something like this, I don't take it for a double top, because if you look at how many touches do you have here now, you have 1, 2, and this is the third one. This is not a double top, but this is a resistance. You understand? You find double top or double bottom, in a trend, whether uptrend or in a downtrend, whether in an uptrend or in a downtrend, that particular leg, like this particular leg now, this is where you look for your double top or double bottom. Because what do they do for you? They helps you to know whether this particular leg is reversing or is continuing. So you look for your double top only on this leg, and on a downtrend, you look for it only on that leg. But when you are in a downtrend and there is a pullback, you're not looking for double bottom. I don't look at that as a double bottom. I see that as a resistance. But you look for your double bottom or your double top on a particular leg. Like for example, now in this leg now, this is where you look for your double bottom. If you go to lower time frame now, before this guy pull back, you must see a double top here or any reversal pattern. So this is where you look for a reversal pattern, not on this entire leg. This is a resistance, because there is a first touch here, second touch, third touch. This has become a resistance. The price is getting to this place and is being rejected. But you look for your pattern in a leg like this, in a trend, whether in uptrend or in a downtrend. Like for example now, this particular one now, you can't really call this a double bottom. Okay, you look for your double bottom in this leg for you to know whether the price wants to continue or reverse. You understand? But for you to now take this together, yes, it's a double bottom, but I see this more of support than a double bottom. You understand? But you look for your double bottom. Well, this is coming down. If you go to the lower time frame now, you will see that this is a trend. At the bottom of the trend, this is where you look for your double bottom, not this entire leg here. This is a support line, a support zone. You look for your double bottom at this leg here, at this bottom here, on this leg, to know whether this price is reversing here or continuing. You look for your double top at this leg, this uptrend here, to know whether this price will reverse here or continue, not on this entire zone. This is a support zone. Why you look for your double bottom? You know, remember we say this chart pattern, they are for reversal or continuation. For you to know whether this trend is reversing, that is when you need to spot, look out for your double bottom here to know whether this trend wants to reverse or wants to continue. Not on this end. This is a support. You look for your double bottom from here. I believe I've been able to explain this to you, and if you have any question, you can please drop it in the comment below, then I'm going to respond to you. And if you have not subscribed to this channel, please do now, so that as soon as I upload the next educational video, you'll be able to get notification. Thank you. Hello guys, welcome to today's training session. And I must tell you that I'm so excited to be here for this training today because of the topic that we are dealing with today, which is entry techniques. Entry techniques. That is, what are the things you need to check out for before you click that buy or sell button? What are the things you need to look out for? But that is very, very important, you know. Then because sometimes your prediction might be right, your analysis might be right, you might know the trend direction, you might know the your point of entry, that is the location to enter. But if your timing of entry, that is when to enter the market, is wrong, you might end up losing your money, because the timing of entering the market is very, very important. That is your execution. Your execution is very, very important. Okay? Like, for example, now, I know many of us might have, experienced this scenario that I want to paint now. Maybe you enter a market for either buy or sell. After you have done your analysis, you have done everything and everything is fine. Then you execute, you enter the market for a buy or a sell. And immediately you enter the market, you just discover that the market or the price just begin to run against you. And as soon as your stop loss is taken out, or as soon as you've blown the account or you have blown the account, then you discover that the price now begins to move in the direction that you have already predicted. Not that at that point, not that your analysis is wrong, not that your point of entry is wrong, but it might be that the time of execution, your time of entry might be the one that is wrong. And that is why you see that as soon as you enter, the market begins to run against you. And as soon as you were taken out, the market now begins to move in your direction. So the timing of entering the market is also very, very important as your analysis. In fact, much more important even than your analysis. You understand what I'm saying now? Your analysis, getting the analysis right is very, very good. You must do that. But what I'm saying that getting your entry, your execution right with the right entry techniques or entry strategies is as much as important as your analysis. That is the point that I'm trying to make here. So now, what are the entry techniques that we need to look at, or what are the entry strategies that we want to look at today? There are three major entry strategies that we're going to look at today, and those are the ones that I use. So those are the ones that I'll be looking at today. And number one of them is candle pattern strategy. That is the first one that we're going to look at. So we're going to look at three of them. The first one is candle pattern strategy. Then the second one is chart pattern strategy. And the third one is counter trend line
counter trend break, counter trend line break strategy. So these are the three entry strategies that I usually use. So the candle pattern strategy, the chart pattern strategy, the counter trend line break strategy. So when you are looking at candle pattern strategy, that is when you are at the location at the point of entry, the area of your interest. Like for example, now maybe the market is making, let me use this. The market is making, from your analysis, you discover that you are on a downtrend. It's making lower high, lower low, lower high, lower low, lower high, lower low. Then you now discover that, okay, at this point, I want to enter the market at this particular point. I'm just using this as an example. So if your analysis have told you that, okay, this is the point where you want to sell, you know, in a downtrend, you look for sell opportunity. In an uptrend, you look for buy opportunities. So now this is a downtrend now. Your analysis have shown to you that at this point, you are to sell. Yes, your analysis is correct. You are to sell at this point, fine. But when do you enter? How do you know that it is the right time for you to execute that sell? Everything I've told you, your analysis, the trend direction, the location, everything that you need to look out for, even your confirmation, everything has told you that, okay, at this point you are to sell. Then you still need an entry strategy for you to be able to click that sell button. Now, and that is what we'll be looking at today. And the first one that I want to talk about now is a candle pattern. So now we have a lot of candle pattern, that we can use. But there are two major ones that I use. Those are the ones that I usually look out for in the market. There are so many of them. We have hammer, we have inverted hammer, we have engulfing, bullish engulfing, we have bearish engulfing, we have inside bar, we have dragonfly, we have doji, we have evening star, morning star, arami, a lot of them, so many of them. Bro, I'm going to be looking at just two in this training, which is the pin bar and engulfing. So now at this level, when you get to your level, your point of entry or your point of interest, let me call it that way, after you have been making the table, you have been having a swing, low swing, high swing, low swing, and so on and so forth. Then you have your location where you want to enter the market. Then you will now wait. If you want to use a candle pattern strategy, you wait at that your location. This is my location now. In a downtrend, you look for a resistance. You sell at a resistance. That is, you sell high, you buy low. That is just the principle behind the financial market trading, whether you trade in forex, stock, commodities, and so on and so forth. You buy low, you sell high. You sell at the resistance while you buy at a support, or you sell at a supply while you buy at a demand. So now let's assume this is our supply or this is our resistance, and I want to sell here. So you now need an entry strategy for you to be able to do this. And what is the strategy that you need to use? So when my price get back to this resistance and I want to sell, I won't click sell immediately as soon as my price gets to this level. I'm not going to sell immediately. So I will look out for candle pattern. I need the candle pattern here that will show to me, or that will confirm to me that truly this price is about to go down. On the charts, there are so many information that the chart is giving you.
that will make you, that you will use to determine your buy or sell, your sell decision. You don't just click buy, you don't just click sell. You understand? So you need to look out for information. So at this point now, at this level now, where my analysis has shown to me to sell. So I will now wait for a candle formation there before I could sell this particular asset. So now, what is the first candle that I always look at here? The first candle that I look at here is, which we're going to look at today, is pin bar. You understand? Call it pin bar. It might be any of this pin bar family. You understand? So call it pin bar. So, and how do I use that? Let's assume this is my candle now. At this level, I want to see something like this. So this is an example of a pin bar, a bearish pin bar. Okay, so you can go and look out for many of them. If you go to Google, you can look for the example of all those candles that I'm talking about. But like the strategy that I use and that I want to teach here now. So the first thing I look out for is pin bar. This pin bar, the information is trying to give you here is that after the price has broken this level and use this place as resistance, okay, move away. After retesting this place, what you need to be looking out for as a resistance is a rejection. With the buyer, buyers are coming. They are coming up here now. From what I just draw here now, the buyer are coming up here. So when they get to this level, will they be able to break up and continue to buy, or will the seller that are waiting here reject the price? Those are the two things. So at this level, you will wait for the reaction of the price. What will the price, what will the market say? What is the reading, the tunes of the market? You don't just buy. So you need to wait for what the market will say here. So when the price gets to this particular location now, this particular resistance, you need to wait, okay, will the buyer continue or will the sellers take over? So when you now see this particular candle pattern, then what this chart is telling you when you say this is that the sellers have taken over. That means the sellers have rejected the price from here. The price has been rejected here and the sellers has taken over. So when you see this particular candle formation at your resistance, then you don't need to waste any time. You know you have to sell, that this market is going to sell. But if you have not seen this and the price is at this resistance, don't say because the price is at the resistance that is going to be sold. No, it doesn't work that way. You need to wait for a confirmation. And one of the confirmation that you are looking at, you are seeing here, is this pin bar, which is a rejection. Okay, so that is one of the entry strategy that you can use. You understand? And we have many of these pin bar. It might be an hammer, it might be an inverted hammer, it might be a shooting star. A shooting star that I've been trying to remember since. It might be a shooting star. You understand? So we have many of all those pin bars. But either a pin bar, a shooting star, an hammer, or whatever it is. So what you need to concentrate on is the tail. Does he have a long tail? The moment you see a candle, a bearish candle at a level, at a resistance with a long tail, that shows a rejection. So what you just need to do is wait for this candle to close, then wait for the next bearish candle, to open, then you enter. And there are two ways you can do that. Number one is you can, as soon as this closes, at the opening of the next candle, you can do what? You can jump in.
You can jump in at the opening of the next candle like this. You can jump in. Excuse me. So you can jump in at the opening of the next candle, or you can wait for the candle. That is the first way of entry. The second way is you can wait for this candle to retrace back to 50% of this guy, the 50% of this guy, you know, for you to enter just the middle of this guy, to retrace back to the middle of this guy, then before you enter. So either you enter immediately like this, or you wait for the candle to first of all retrace back to 50% of this guy before you enter. So either way, you are good to go. But one thing is, one give you less risk. Like for example, the first one, if you enter from here, because your stop loss will be here. Let me use myself. I'm just trying to say is from here to here, you have lesser number of pips to risk than when you jump in from here. Okay, so it all depends. They are both the same thing. All you need to do is put your stop loss here. If you enter from here as soon as the new candle opens, you enter from here, you are right. And if you wait for it to retrace, for you to reduce your risk, you are also right. But one thing is, there is an advantage and there is also the disadvantage. Like for example, if you want to wait for it to retrace now to reduce your risk before you enter, it might just continue to drop. It might not retrace and it will just continue to drop. And if you enter from here and it begin to retrace, you know, that means you have much risk. What if it retrace and eventually break this place? That means you are risking more when you enter here than when you enter from the 50%. That is just the difference between the two. You understand? So in the nutshell, what I'm just trying to say is, when you get to your resistance, when the price gets to your resistance level, try to wait to see the reaction of what the market will say before you jump in. And the reactions you have to look at, one of the reactions you have to look at is the pin bar. You understand? A candle with a long tail. So when you see it, then you can enter. That is one of the signs that the price will drop. Then another one that I'm going to talk about is the for under the candle pattern strategy is the engulfing. So we have bullish engulfing, we have bearish engulfing. But before I go to that, then this is in the bearish scenario now. Now let us look out for a bullish scenario. So in a bullish scenario, we have price moving up like that, and maybe price come back to your location or your point of entry or your point of interest. So what do? You wait. Okay, you wait for the price. You don't just jump in immediately. Wait for the reaction of the price. And what are you looking for? In this scenario, you are looking for a rejection from here. You are looking for a rejection. Okay, you are looking for a rejection. And what is that rejection called? It's a pin bar, a bullish pin bar. So we have a bearish pin bar and we have a bullish pin bar. So we have a bearish pin bar and we also have a bullish pin bar. So this is a bearish pin bar we have seen here. This is a bullish pin bar. So on your support, you know this, as you are going up the trend, you're having high, low, higher, high, higher, low, higher, high, higher, low, higher, high, higher, low. So at this support on resistance now,
So when you see this is a location, this is your point of interest according to your analysis. So now you want to enter. You will not enter until you see a sign that will show you that, okay, it is time for you to enter. That is when the timing of your execution, that, okay, it is now the time for you to click your buy or sell button. So you wait for this. When you see a rejection like this, a pin back candle, a candle with a long tail, it shows that when the sellers are coming, this is a retracement. When the seller got here, they try to break here, but the buyers that are here, they are much more than the seller, and they are able to do what? They are able to reject the price. So when you see this at a level in the market, at your point of interest in the market, what is telling you is that the buyer are taking over. Then what can you do? You just go ahead and do your buy. You understand? Just like what happened here, you can, buy immediately. You can buy immediately as soon as the new candle opens, or you wait for a retracement back to 50% of this candle, back to 50% of this candle before you do what? Before you sell. Before you buy. So either way, you are good to go. Then your stop loss here, and your entry here. So either your entry here or your entry here. So either way. So you can enter immediately, this candle closes here and the new one opens. Then, or you can wait for it to retrace back to 50% before you enter. Then your stop loss here. So that is the first entry candle pattern strategy that we'll be looking at. Then the second one is called an engulfing strategy. Engulfing strategy. So what the engulfing will do is, when you are in a downtrend like this, and you have a point, according to your analysis, you have a point of interest here, that, okay, when the market pulls back to this place, I want to believe first and foremost that I'm not talking to a completely beginner here. So you understand when I say a downtrend, you understand when I say an uptrend. I want to believe you know that. If you don't know that, go and watch my video on market structure. That one will give you a better understanding of what I'm talking about. So here, when you're in a downtrend and you have your point of interest here, okay? So for you to buy, to sell from here, you will wait for the market to then tell you that, okay, I am ready to begin my down move. So what do? You wait for this, or for something like this. This is a bullish candle. And this will be a bearish candle. That is an engulfing. An engulfing candle is a candle that has a bearish engulfing candle is a candle that have a small bullish candle followed by a big bearish candle. A small bullish candle followed by a big bearish candle. That is, the bigger candle must completely engulf the small one. So in the bearish scenario, this red candle must completely engulf this green candle in body and in wick. Both in body and in wick. You understand what I'm saying? Both in body and the wick. It must completely engulf. So I'm still going to show us all this on the screen, but I want us to have a perfect understanding first.
before we go to the screen. So this is a perfect example of an engulfing. So at your resistance, you might first of all see a rejection. Fine, even if you don't see any rejection, the moment you see this at your resistance level in a downtrend, okay, what do? You know the price, the market has informed you that it's going south, that it's going in the sell position. So as soon as you see this, you can just do what? Jump into the market. As soon as this candle closes, this bearish candle closes, that's form an engulfing to show you that it wants to sell. So as an aggressive trader, you can do, there are two ways you can enter this market. The first one is immediately this candle closes, you jump in, okay, and you put your stop loss here, your entry here, your stop loss here. You understand? Then the conservative entry, you might wait for a retest. Okay, you might wait for a retest of this candle. That is a retest of this candle, maybe like something like this. Excuse me. You might wait for something like this to happen before you enter. So after a retest of this candle, then as soon as this candle closes, you can jump in. So far, this candle did not close above this bearish engulfing. But the moment it closes above this bearish engulfing, that is invalid. But so far, the close of this candle is not above, is still within this bearish candle. Then you can jump in, then the price will begin to drop. So that is for the bearish engulfing. For the bullish one, your price is going up the trend, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. You have your points of interest according to your analysis. What you do is wait for a bearish candle like this, okay, to form, a bearish candle to form. Then a bullish candle. That will completely engulf the bearish. That will completely engulf the bearish, both in body and in wick. It's just the opposite of the bearish, both in body and the wick. Must completely engulf both in the body and the wick. So it must completely engulf the red candle both in body and the wick. So this is your engulfing now. So as soon as you see this on your support level, the next thing is you can either wait for a retracement back to this, in the middle of this place, then take your buy, or you buy immediately. The difference between the two, as I explained the other time, is your risk. If you enter immediately as soon as this one closes, you are taking more risk than when you allow it to retrace. So from here to here, if you look at this, from here to here and here to here, you can see that from here to here, you can see that you are taking higher risk than from here to here, where your stop loss is.
You understand? So that is just the difference between the two entry. So in a summary, in a downtrend, if you want to enter the market using engulfing strategies, you wait for engulfing to form at this level. You might enter immediately, or you wait for a retrace before you enter. In an uptrend, when you see a bullish engulfing, it's a signal to you that the market will continue to go up right from here. The same thing with pin bar. When you see pin bar here at your resistance, it's an indication that the market will sell. When you see a pin bar at your point of interest, at your support in an uptrend, it's an indication that the price will buy. So that is the first strategy that you can use, for your entry. So you don't just enter because your analysis say you should sell, or your analysis say you should buy, then you just jump in. No, you need to wait, for a confirmation, whether you use a candle confirmation or chart pattern confirmation or any other confirmation. So this is one of the confirmation that you see that will determines whether you have to jump into the market. So the second one we're going to be looking at is a chart pattern. The chart pattern. So if you don't have so much knowledge concerning chart pattern, I've done a video on that. You can go and watch that on my YouTube channel. You see the video there. Just look out for it there. So what the chart pattern is telling us is that we want to use chart pattern strategy. That means after you have done your analysis, just like, here we are talking about entry techniques. So after you have done your analysis and you now have a location where you want to enter, the next thing, like I said earlier, is for you to now look at the entry strategy, for you to have a timing entry. Not that you enter, the market will still not move and it waste your money, your time before it now begins to move. What is the appropriate time to enter? That is why we are looking at all this. So we've seen candle pattern entry strategy. Then we now want to look at chart pattern entry strategy. And there are two major ones that I'm also going to teach us in this training. The first one is double top. Double top. Let me even write them here so that you'll be able to remember them. Let me write it. So the two that we did here, let me say EG. We did pin bar and the other one engulfing, whether bullish or bearish. Engulfing. Then for the chart pattern, we'll be looking at double top, bottom, head and shoulder. Or invited head and shoulder. Double top or double bottom, and so we look at head and shoulder are invited head and shoulder. So those are the two that we'll be looking at here. Now, number one, which is double top and double bottom. How do you use double top? How do you use double bottom? You use double bottom for your entry, when you are in a downtrend, as the price is moving down like this, and you know, according to your analysis, that they are clearly in the downtrend, and you now have a point of interest for you to enter the market, which is your resistance level here. The market has made a down move, and it has pulled back to your resistance, and you want to enter. You know that is your point of entry. But now, how do you enter? Using pattern. So as soon as your price gets to this place, to this your point of interest, what do? You now be looking for a pattern. So most of the time when you might need to go down to a lower time frame. Like for example, if this is your 4 hours now, this is your 4 hour chart. As soon as your 4 hour candle gets to this location, you can now go down to maybe 1 hour or 15 minutes to go and identify or look out for the pattern at this point. I'm not saying at this entire level. I mean, at this point, this last candle, if this market is going to drop from here, you will see a pattern at this leg, at this particular leg, in your lower time frame. You will see a pattern there. So all you need to do is go down to the smaller time frame, go and look out for pattern. So if you, on your lower time frame, if you see something like this there, you see something like this, then you know you are in for a sell. You understand? At this leg, you see a pullback, then the market try to pull up again, and the price was still rejected here, giving you a double top. What double top means is you have one top here, you have a top here, you have another top here, making what? Making double. So when you see something like this on your lower time frame, then you know the market has confirmed for a sell. Then all you need to wait for is a neckline break. This is your neckline break in a double top and double bottom. So you have your double top, you have your neckline break. So just wait for the price to break this neckline. As soon as the price breaks this neckline, then and closes, and the last candle the moment the last candle closes below this line, then you know there is a confirmation for a sell. So now there are two things you can do there. Then you can either jump in immediately and put your stop loss above here, or you wait for a retracement, just like I explained the other time. If you jump in immediately, you understand, that means you are having a larger risk. So from here to here now, from here to here might give you what? Something like, let's say 236 points now. Let's say 236 points or 2.36 pips. But if you enter from here, maybe after a retracement back to this place, it might give you 1.33 or 133 points. So 230, sorry, even like from here now, this is 94 or 0.94. You understand? If you put it from here to like, yes, you're having 2 point something, 2.03 or 203 points. You understand? So those are the differences. So, but what you need to look out for at this level is double top. The first point, the second point. That is when the price tries to pull up, but it couldn't break this previous high. That is, if the price couldn't break this previous high, that's when you say you have a double top. So the moment the price is rejected from here and it breaks, the SMC traders, they will tell you this point a change of character. They call this point a change of character, but I call it a change of trend. So when you see this double top here, that the price is rejected, it couldn't make new high, and it now come down and break this low here, I call it a change of character, a change of trend, but the SMC trader will call it change of character. So the moment you see this, you know the trend has changed from uptrend that is coming from to downtrend. You understand now? And the same thing happened here. The same thing happened here. You are in an uptrend, higher high, higher low, higher high, higher low. And the price gets to your point of interest, your location where you think it's right for you to enter. What do you look out for? If you want to use chart pattern strategy now, what do you look out for? You look out for double bottom. Double top, you look for double top in a downtrend at your resistance, but you look for double bottom in an uptrend and at your support. So this is your support now. What we'll be looking out for here is double bottom. So the moment you see this guy now, this is a double bottom. That is, the price will not make new low. It couldn't break this low. This is a low here now. It couldn't break. No, this is a trend coming down. You're going to see them clearly on the charts now very soon. This is a trend coming down like this. Now it's not coming down straight like this. Definitely it should be making a higher high, higher low, higher high, higher low as it's coming down. Something like this. It should be coming like this. So the moment it got to this place, it couldn't make a new low. That means you couldn't make a new low and then pull back, something like this. That means you have double bottom. Okay, then this will be your neckline. So the moment price breaks this neckline and then retests from here, either to here or below. So most times it's good for you to wait for a retest. After a retest, then you can now join the buy. But the moment you see this pattern, a double bottom, a neckline break, then you know the direction of the market has changed. All you need to be looking out for is buy now, no more selling. If you have been selling from here down to this place, you stop your selling from here, then you need to look for a buy. So this is double top, neckline break, double bottom, neckline break. Then around here, you look for your entry. Or as soon as the candle closes above this neckline, you can jump in an aggressive trader, but your stop loss will be down here. That means you are taking an higher risk or more risk. But if you're a conservative trader, you let it pull back, either pull back to this neckline or even pull back below. And you can use your Fibonacci, your Fibonacci to confirm where it's pulling back to. So if it pulls back to 61.8, then you can take it from there. So all you need to do is wait for your chart pattern at this level to form, neckline break, retrace, then you join. So that is all that you need to do from that. Okay, that is all you need to do at that point. So I believe you understand the double top and the double bottom now. And if you don't understand what I'm saying, go and watch my video on chart pattern. It will give you better explanation. Then the second one that I want us to look at is head and shoulder pattern. Head and shoulder. It takes the same form, but the only difference between the two of them is just the pattern. As I call this one double top and double bottom. That means for head and shoulder at this level, you might see something like this. When the price gets to this place, let me clean up this one. So for head and shoulder, when the price get to this place, you might pull down like this, then break up this place, pull down again, and then come down again, then come to this place, then before coming down. So at this point, what do you have? At this point, you have a neckline break. Okay, this is your neckline for head and shoulder. This is your left shoulder. your right shoulder, and this is your head. That is why we call it head and shoulder. So the moment you see this chart pattern, you see this pattern at your point of interest or at your location or at a resistance in a downtrend, the moment you see this, then you know you are to sell, that the price has confirmed sell. So either you are using candle pattern or chart pattern, you must wait for something to give you. You don't just buy or sell at this point. You might think this place is going to hold, and it will not. It will just continue to buy. So that is why you need to wait for the reaction on what is going to happen here. Whether you want to see a candle pattern that will tell you the price wants to come down, or you want to wait for a chart pattern. So if you are waiting for a chart pattern, when you see this, this head and shoulder, then you know, okay, you have to sell. Or you see double top here, then you know you have to sell. So when you see this pattern forming, all you need to do is let it break the neckline. Yeah, as soon as this red shoulder, it must form the left shoulder, the head, the right shoulder. So as soon as it forms the right shoulder, then let it break. The moment, because it might not, if it doesn't break this neckline, that means the pattern has not completely formed. You must wait for the pattern to completely form before you can say you want to sell or buy. So not until there is a neckline break here, this pattern has not completely formed. If this pattern, this price gets to this neckline and it pulls back from here, it might end up breaking this place and continue to go up. But as soon as it breaks this neckline, at least 70 to 80% of time, you will know it's going to drop. This price is going to continue dropping. So this is the second pattern that I usually look out for. The first one is top, double top, or head. The second one is head and shoulder. Then in an uptrend, I have this going up, going up, going up. Then after a retracement, at my location here or at this point of entry, I'll be looking for, so in the downtrend, you'll be looking for double top and double bottom. Okay. Then in a downtrend, you'll be looking, an uptrend, you'll be looking for inverse head and shoulder or double bottom. And also, if at this point in time, you can see, if you see this pattern here, either double top or double bottom, either double bottom or head and shoulder, inverse head and shoulder here, is an indication that this price wants to pull back from here. You understand? But because I like to trade in the direction of trend, that is why I use this method. Normally, your double bottom or inverse head and shoulder, you usually look for it at the bottom of a trend to show that the trend wants to reverse. You understand? So if this trend wants to reverse now from here, you might see double bottom, you might see inverse head and shoulder. But in a trend continuation, you see it here. But in a completely trend reversal, look out for it here. So if you see it here, you can begin to buy from here. If you don't see it here, then you know the trend is still continuing, because if you have the break of structure here, that means the trend still continues. But if you see a chart pattern here, then you know there might be a reversal that you can buy. So now let's look at the uptrend now. So we have high, low, higher, higher, low, higher, higher, low, higher, higher, low. Then at this point now, you don't just buy immediately. You wait for your chart pattern to form. And all this thing that I'm talking about, is better you look out for them on higher time frame, starting from 4 hours upward. That is where they are more, reliable. If you are looking for chart pattern on 15 minutes, it might not be as reliable as seeing them on higher time frame. So at this point now, if you see your chart pattern here, whether double bottom, or you see, okay, like we have talk about double bottom. Now we are talking about head and shoulder. So if you see your head and shoulder here, that is something like this, inverse head and shoulder. Maybe the price pull up here, come down, pull up again, come down, then now break. So if you see this one anywhere on the chart at a level, then you should know you have to do what. So if you see something like this, then you should know you have to do what, you have to buy. All you need to do is just make sure you wait for a neckline break. This is your left shoulder, this is your head, this is your right shoulder. Just wait. The moment the right shoulder is formed, wait for a neckline break. Waiting for a neckline break is very, very important, but that is when the formation is completed. So as soon as your candle closes above this neckline in the downtrend line, this is your, if you go to lower time frame, this will be a downtrend. So as soon as you see it at the end like this, forming this head and shoulder, then you want to continue, that this market will continue to buy. And also, if you see head and shoulder from here, maybe you see this head and shoulder now at this top here, the market is making an up move there. But at the top of this trend now, if you see head and shoulder here, then you should know the market is ready to sell. But the selling will not be a counter trend. You understand? That is why I'm using this one as an example, so that you can know that you have to trade in the direction of the trend. So this is my pullback here. From here to here is my retracement. So for me to know this price wants to continue, so if I see a chart pattern here, that is when I will now jump that, okay, my uptrend still continue. So in a nutshell, when you're in a downtrend and your market pull back to a resistance, look out for a chart pattern or a candle pattern before you continue to sell. In an uptrend, where after a pullback, look out for a chart pattern or a candle pattern before you do what? Before you continue to buy. And at the top of the trend, at the top of an uptrend, if you see a chart pattern, either a double top or head and shoulder, you can sell. At the bottom of downtrend, if you see an inverse head and shoulder or double bottom, you can also buy. So that is how we use pattern, chart pattern and candle pattern for entry. So you don't just jump in at a level that, because of the analysis, the market will drop from here, then you just jump in as soon as the price gets to that place. No, you need to wait for confirmation. If we are talking about waiting for confirmation, these are the confirmation we wait for to say before we jump into the market. So I believe we all understood that, or we all got that. So the last one that I'm going to talk about now is the counter trend line. That is the last strategy I use. Counter trend line. So as you are in the downtrend now, the market is making higher, lower, high, lower, lower, high, lower, low, lower, high, lower, low. So when the market pulls back to your location like this, to your level, what you need to do is just draw a trend line that will touch at least 2 points. This is normally you're supposed to, you're in a downtrend, you draw your trend line from here to here. You understand? That is your downtrend line. But if you now want to draw a counter trend line, that means you draw it against the normal trend line. So this is my counter trend line now. So now with these strategies, what do? You wait for the market, the price to break this counter trend line. You are in the downtrend. This is your counter trend line. You wait for the price to break it. As soon as the price break this counter trend line, that is your first confirmation. Then you now wait for it to break this structure that will confirm to you, because sometimes it might break this trend line. If it doesn't break this structure, there is no change of trend. There is no change of character yet, because it might retrace back to this place and give you double bottom here and start to buy again. But as soon as it breaks this structure here, that is a change of trend or change of character. Then you now wait for it to pull back. After a retracement, then you see some bearish movement here, or you use Fibonacci, or you use candle formation here, then you can now begin to sell. But the first thing you need to look out for is, for this counter trend line strategy, let your price break this trend line first. Then after that, let it retest or break the next structure, then let it retest before you sell. The same thing in an uptrend. You draw this in an uptrend, you are expected to draw your trend line like this, but your counter trend line will not come this way. Just try and pick two what just try and pick two dots. The moment you are able to connect two dots, then wait for the price. Let me use more for just for clarity. So the moment you are able to break, normally it's supposed to be here, but this is where the trend change. So the moment you're able to break this particular trend line from here now, and you're also able to break this structure here to give you a change of trend, then all you just need to do is wait for the price to pull back. Then what do you do? The moment it breaks that trend line and break the structure, that means the trend has changed. And just wait for a pullback, then move forecast for a candle formation here, or use Fibonnacci for your 61.8 or 50%. Then you just do what? You just buy from there. So those are the entry strategies that I want us to look at today. So I've talked about candle pattern strategies. When you look out for candle pattern, e.g. pin or engulfing at your location before you enter for buy or sell. I talk about the chart pattern, and I talk about the double top or double bottom and head and shoulder, inverted head and shoulder. That is, you must see all those patterns at this your location before you make your conclude on your buy or sell decision, before you play that buy or sell. Then we talk about counter trend line break, where you make sure the price first of all break the counter trend line, break the structure, then retrace before you now sell or before you now buy. So now let us go over to the charts while we look at some of those patterns that we have been talking about since, and how we can use them for our entry on the live charts. So like for example now, we look at this AUD USD 4 hours charts. Let's try and identify some of these things that I've talked about. See, currently the first one that I'm going to show you is this. I was on this trade, when the price, dropped up to this place. I was actually sleeping that time. I said, thank God I set my first take profits to this place. Then my second take profits to this particular line here. But unfortunately, I was sleeping. It happens in the night. So when the price got to this place from here to here, actually gave me the first TP here and pulled down to this. But by the time I wake up, the price has come back sharply. The price has come back sharply to this point here. So I was just waiting whether this price will go down again and all that. But unfortunately, it ended up closing with this long tail as this pin bar. So immediately I saw that, I know something is going to happen. But because of the, that's why psychology is very, very important, that your right state of mind is important when you are trading. But because of that pain, that, no, see, this price has dropped to this place. No, let's see whether it will come back. I refuse to close. If I had known, I would have closed the stuff in profits for me. At least it has given me, I have 3 positions open on this. I put one here, one TP here. Then the remaining 2, I plan to close them on this line. But the one of them has closed in profit here. But the 2, I was hoping that the price will come back down. But unfortunately, the price just closed with this pin bar. So immediately I saw this pin bar, I know this thing is going to reverse. Because not only did I have pin back here, this is like a possible double bottom. This is a low here. It broke this, but it did not close down. Not until it closed, this candle closed below this place. We can't call this place a continuation, but since it did not close below, the price closed below this, so we can call this one a double bottom. So when I saw this, I know this price is going to be, but because of the greed and all that, I didn't close it. I was hoping that it's going to continue down the downward move and all that because of my analysis here. But unfortunately, by the time the next candle will close, it closed bullish. That's when I know that I've lost the stuff. You understand? So what I'm just trying to tell you is that anytime you see something like this is a first low, this is the second low, this is like a double bottom. You should know you're going to have a reversal. This is a downtrend. If you remember what I was teaching earlier, this is a downtrend. Now getting to this place, we have a point here, we have another point. It couldn't break lower. Then that's not the only thing. We also have a rejection candle, which is a pin bar. So this is an indication, all indication that this price is going to reverse from here. And what do you have? This is a double bottom now. This is your neckline break. What happens? The price breaks this place, pull back, then it continues to move. So this is a clearly example of a double bottom in a downtrend. If you understand, then this is a clear example of a pin bar in a downtrend. Okay, and now after we have a downtrend, what do you have here? We have an engulfing here, a bullish engulfing. Is an indication that the price will continue to move higher. So when you see all this together, then it gives you an information that you can enter the market, that the price is going in your direction. So this at the downtrend, I saw double bottom. Here I have a change of trend or a change of character, because the price breaks this previous structure, retest. Then from here now, even if you didn't enter here, this is the first entry. With this pin bar is the first entry to this place. Then this is the second entry here. After the neckline is broken, this is your second entry, upward. So when you see this in the downtrend, then you should know it's an indication for you to, this is a double bottom for you to buy. Then when you also see a pin bar, it's an indication for you to do the same thing. You understand? Then let's go and look out for more. This is double top now. If you look at this price is moving in an uptrend here. But all of a sudden, it gets to this level here. And the price begins to do what? Begin to pull down. But before it change the direction, what do you see? You see a double top from here. If you go to 1 hour, you will see it clearly. So when you see this double top here, it's an indication that the price wants to change direction. You can see this is double top and this is neckline. So as soon as this neckline breaks, what do you have? The change of trend, and you can see the way the price has been moving down. So when anywhere you see this, especially on the higher time frame, then you should know the trend is about to change. So if it breaks the trend line, this is your double top, this is your neckline. Breaks the trend line and closes, then you wait for it to retrace. But in a situation whereby it's not going to retrace, you will have known that this is where your lower time frame comes to play. If it's not going to retrace, you can go to lower time frame to see what is happening at this particular neckline. If it's not going to retrace, you will know, so that you can. But the most important thing is it must complete the formation by breaking the neckline. So that is the second one. Let's see whether we can see head and shoulder. So what we have here is an inverse head and shoulder. You can see this is a level. You understand? I have a counter trend line here, but it fake out the counter trend line, not close below. If you look at it on that time frame, because I know when this happened, that's why I tell you that. So when they got to this place, it gave me left shoulder here, the head, and the right shoulder. This is my neckline. And you can see as soon as it breaks the neckline, what did you see? breaks the neckline, it retested, then continue to move with an engulfing. And this is a perfect example of an engulfing. You understand? At this level, you have a small candle, you have a bigger candle that completely engulf this. So after that, what do you see? You begin to see the stuff moving up. So we have seen an engulfing, how it works from here. We've seen inverse head and shoulder. This is another engulfing too. So when the price was coming down here with this small one, but this is not a complete engulf. This one did not completely engulf this, but this is still an engulf. But this is a perfect example of an engulfing. So the small candle, the bigger candle, completely engulf this, and the price begins to move. So when you see this at a level, don't joke with it. It's going to move in the direction of that engulf. This is a bullish engulfing. So you can say this is also a bearish engulfing, but this one is not at the level. But if you want to join it together with this, you can say you have a double top here. The price is in the downtrend. This is the perfect example of the one I gave earlier. You have a double top, okay? You have the neckline break, it breaks it. Then you draw it very well. Double top, neckline break, and it retested. What did you see? A sell. So when you see this formation now, double top, neckline break, it retest, then you see a drop. Then for you to turn again, give you another pattern, head and shoulder. So those are the things that you need to be looking out for in the market. Look out for your pattern, you look out for your candle pattern, you look out for your chart pattern. And also, if you look at this place now, this is a typical example of counter trend line. We talk about candle pattern, we talk about chart pattern, and we talk about counter trend line. This is how to use your counter trend line. This is in the downtrend right now. Now the market is doing what? Retracing. So for you to know whether this market now will continue after the retracement to continue to sell, you draw your counter trend line. We are in the downtrend, but it's retracing now. So you draw your counter trend line to make sure you have to at least 2 or 3 points. So at least 2 points. So the moment you're able to get it at least 2 points, you use it to draw your counter trend line. The moment you draw it just the way I draw it now, then you wait for the price to break this counter trend line. You can see that here the price did not break it, it touched it here. Then even from this point, you can see that even from this point, the price touched that trend line, but did not break it, so it moves up here. But after that, it breaks it. So since it has broken it now, we now need to wait for it to also break this structure here. We need to wait for it to break this structure. If the price is unable to break this structure, then there is nothing we can do than for us to do what? For us to wait. You understand? So since it did not break this kind of trend, this structure, yes, it break the counter. It has broken the counter trend line, but it did not break the structure. Remember, I told you the structure must be broken. Then after that, you wait for a retracement. But now, the structure was not broken, but the counter trend line was broken. So to me, that is not a good confirmation. There is no confirmation for sell yet. Because now at this point now, this has formed a double bottom in an uptrend. Remember, go and look at, you can rewind this video and look at, check my explanation. This is an uptrend now, but now it has formed a double bottom here now. It broke the counter trend line, fine, but it did not break this. But with this, it has formed another double bottom, which means this is not selling yet. Assuming this structure was broken to the lower side now, so okay, this is going to sell, but this cannot sell now. This is a live chart that we are looking at now. This is AUD USD live chart. So at this day now, this particular pair is not going to sell. It's still going to continue the buy. Not only that, it couldn't break this structure. At the close of this 4-hour candle, you can see what it gave us. It gave us a pin bar. This pin bar is an indication, is a candle, pattern that has informed us that this price will continue to buy, it's not going to sell. It couldn't break this structure, and it closed with a pin bar. It's an indication that this is not going to sell, that this is going to buy. This has given us a double bottom. Not only that it gave us a double bottom, it gave us another candle confirmation of pin bar. So this is an indication that this is going to do what? That this is going to buy and not sell. So that is how you use your entry. Then you use your entry strategy to get a good entry, not just to click a buy or sell button. So I believe I've been able to give you good explanation concerning all these entry strategies. Talk about, and also been talking about so far the candle strategy, the chart pattern strategy, the counter trend line strategy. So if you still have any question, please don't hesitate to let me know.